Good evening, everybody, and welcome to the March E.M.I. From Sundaram Mutual. Those who attended last month, you could recollect that I had spoken a lot about the overall Indian economic situation, the budget, as well as the long-term economic outlook. But because of paucity of time, we are not gone into the markets and investments. So today I propose to give a brief update on the economic affairs of the country, and then move on to the markets and investments in a little greater detail. So to start off with, if you can look at the screen, as you can see, the stock market. The reason we focus on this as an E.M.I. program is because the market delivers returns through earning growth expectations from the economy's performance and also from the change in the P ratio, the valuations from demand from stocks, which, as you know, comes from foreigners as well as domestic investors. So let's proceed to give an update on the Indian economic status. So this snapshot, which is just one day before the budget, is the Indian Economic Survey's update on the economy. As you can see there, the top left tells you that the fiscal deficit is on a declining trend. Inflation is on a stabilizing trend. And the left, you can see that we have healthy foreign exchange reserves around $560 billion, which is the fifth largest in the world. The bottom right, if you see the three economic components, right, is sectoral components of the GDP. That's services, industries, and agriculture. Starting from the left with agriculture, you can see that because of good monsoons, we've had a fairly decent low single-digit growth in agriculture throughout the last 3 to 4 years. Industrial growth, after dropping during the COVID and the pre-COVID period, has bounced back because of the low base and then stabilized at about 4%. We think this should go higher in the coming years. And then the services sector, after just dropping during COVID, has a strong bounce back with high single digit. So then that's the reason why in the central circle, if you see GDP growth, we have maintained a healthy high single digit 8.7 and 7. And next year we expected somewhere between 6 to 6.8, depending on how the world economic situation progresses. So then giving an update, because that was historic data there, we see that the index GDP numbers show that both private consumption and exports have been rising. But the government expenditure most recently has been tapering down because the government has dialed down the expenditure on the revenue side of the balance sheet, right? Inflation, as we just spoke about, is fairly steady. And from a WPI perspective, also, if you see, CPI has also moderated. Right. And looking at the short frequency indicators on this slide, we've shown how after a drop during the first wave and the second wave, all indicators, whether it's power, rail freight, two-wheeler sales, GST collections, exports, passenger vehicle sales, e-vehicles, and vehicle registration, all are going through a kind of V-shaped recovery. Right. And on the rail freight indicators, if you see across the range of commodities which are shipped by rail, their indicators are broadly steady. Electricity consumption has been steady, though it's slightly eased in February. Rail passengers, while it's sharp V-shaped recovery, it's not yet reached the pre-pandemic 2019 average, whereas air traffic has overtaken the pre-pandemic 2019 levels, right? Air cargo handled, there is a marginal pickup. Sea cargo traffic has seen an appreciable pickup, which should obviously result in exports and imports. So there, when you see the seasonally adjusted trend in exports is holding up well. Services exports are also seeing a very sharp pickup, as you can see, and formalization of the economy. People moving from the informal sector to the formal sector, the best way to look at is the Provident Fund organizations, payroll additions, which month on month is going on increasing. So more and more people are coming from the informal sector to the formal sector, right? So under NREGA, employment demanded is less, which is showing what? A remigration from the rural areas back to the urban areas, which is what even the average rural wages, because now there's a shortage of labor in rural India. As they're moving to urban, you're seeing rural wages on the rise, right? So the other thing is this pollution levels. If you see month-on-month track, and the last two columns gives you a sense. Last year, end of February, what was the pollution in major cities? And this year, end February. As you can see, this year, pollution has gone higher in almost all the cities, which is bad news for our health, but it's very good news to show the recovery of the economy in terms of vehicular movement and all the likes, right? Credit offtake has been robust, whether it's industrial credit, whether it's services credit, or it's non-food credit. So all the aspects of credit have been rising. And PMI, which is a good predictor of GDP, remains healthy above 50 for both manufacturing and services. And finally, the economic activity tracker that Morgan Stanley prepares, which predicts the coming GVA, is clearly showing that the economic growth for the next few months is on a very strong wicket, right? As a result of which, if you see that India's growth path is on a rising trend, and from our current 3.4% of world GDP share, we expect to hit 4% of world GDP share in just the next few years. So today, India, which is in a fifth rank in terms of the size of GDP, we think that we should be easily able to overtake Japan and Germany by 2028 and become the third largest GDP country in the world. And if that journey continues by about 2036, we think that we should be able to reach something like a total GDP of $7,939 billion. So $8 trillion by the end of the decade on a normal case itself. And hence I see that by the mid 2030s, right, we should be actually a part of a tripolar world of the US, the China and India, more or less on equal footing in terms of size of GDP. With that strong economic footprint, both from the short term and a medium term growth, let's move to the markets, as I promised at the beginning of today. Now, on the markets, the story, if you see, the important thing to note is what is causing the price valuation changes in the market. On the left-hand side, the pie chart tells you the ownership of the Indian stock market. As you can see there, 45% of the market is owned by the promoter of the company. Now, they don't sell their shares, so those shares do not come and alter their prices. So they don't matter to us from an investment perspective. Is the balance 100 minus 45, the 55%, within which I've given the breakup on the table on the right, you can see 37% of the market is controlled by FIIs. The rest is spread across domestic mutual funds, individual investors, and insurance. And even if you take mutual funds and insurance, ultimately it's because retail investors give money through distributors to the mutual funds and insurance that they buy. So actually, an insurance fund manager or a domestic mutual fund manager only can decide whether to buy large, mid, or small cap or sell large, mid, or small cap. Ultimately, if investors give the money, they have to buy. So in terms of deciding the valuation of the market and the direction of the market, right, the behavior of individual retail investors, if you can just find some kind of a logic to it, you'll be able to get a sense. But the people who on a day-to-day basis who create the volatility are the 36.7% of FIIs. Now, of that 36% FIIs, if you see, almost a quarter comes from long-term money, which is sovereign wealth funds, pension funds. What do they take a call? They take a call based on share of GDP. You saw that already. We are talking about India's GDP share going from 3.4 to 4%. So obviously we can expect sovereign wealth funds share to go up. Already in the last 5 years, it has gone from 12 to 16. And over the next 5 to 10 years, you can expect the 16 to go towards 20. So that, in fact, when between September and October, September 21 and July 22, there was outflow from the Indian market. These people actually were net buyers. So clearly, these long-term money is not the one causing the short-term volatility. The volatility is caused by the mutual funds and hedge funds, where one component of passive mutual funds, again, it's the investors abroad who are giving money into the ETFs, automatically they will come and buy. So that is again over thousands and millions of investors, you can't predict it. But the active mutual fund managers, the hedge fund managers, take a call on a country's investment based on their view. Now, there, if you go and see the view, I have tried to track here for you, right? Something like every quarter since COVID, what have FIIs done? What have domestic mutual funds? As I already mentioned, domestic mutual funds will sell if their investors are redeeming, will buy if their investors are giving them money. So the second line tells you that in the post-COVID phase, because of the fear of an economic slowdown, Indian investors pulled out money from mutual funds and hence mutual funds were net sellers. But from April 21, they have been consistently net buyers. It's an important point to keep in mind. As you know, there's something like a 13,000 crore SIP book, which is currently running in the mutual fund industry. That means every month, guaranteed 13,000 crores of money is coming to mutual funds to buy stocks in the market. But let's take the top line, the FII activity. There, as you can see, during COVID, it was all green. Only from October, November, December quarter of 2021, for the next 3 quarters, there was heavy selling and back again there's buying. So what is the secret behind this sudden buying, selling, buying? It's the chart on the below that you see the graph. That graph is the price of crude oil. So when crude oil prices dropped, you saw that FIIs have put in money. When crude oil prices started rising, you see that FIIs pulled out money. Again, when crude oil on the right-hand side, if you see when it started dropping, FIIs brought in money. Why? Because India as a country imports 83% of its oil. That rise in oil prices has 8 different negative effects on India, and hence active mutual funds and hedge funds, when they see oil price rising, they fear that not only the currency would weaken, but stock market companies' profits would go down, demand will go down, and GDP will go down because inflation, imported inflation from oil will rise. So this fear factor is what caused them to pull out money when oil prices rise. But when oil prices fall, these same 8 negative factors will turn into 8 positive factors, and they pump in money because of attractiveness. So oil is that one which causes active mutual funds and hedge funds to put or pull out money, and they are the ones that cause a volatility in our lives, right? And hence, because you have seen FIS being volatile, but you've seen consistent domestic buying, Indian markets volatility, the red line, is far lower than the world markets volatility. So all that we worry about our volatility, let us realize that the world stock market has been far more volatile than the Indian stock market. So then when we now come to the market's performance, because FIIs in the last 2 quarters, I may take you back to the couple of slides before. So see, if you see July, August, September last year, October, November, December. So pretty much the last 6 months of the year, FIIs were net buyers. Domestic mutual funds are also net buyers. Hence, as of December 15th, if you see the table on the top, even in that month for 15 days, FIIs brought in 9,000 crores. So the stock market indices as of December 15th were all green, whether it's large cap, mid cap, small cap, whether it's 1 month, 3 months, 6 months, 1 year, or 3 years. But suddenly by December 30, the picture changed because FIIs sold about 3,500 crores. And you saw the 1 month returns turn negative. Why? This is a normal every year phenomenon that in the last 2 weeks of December, hedge funds book profits to be able to pay bonuses to their fund managers. So this also was a very normal thing, and people thought in market would bounce back in January. But we all know that the union bet also came through very strongly on 1st February. Despite that, right from January 1st onwards, FIIs have been continuously, as you can see in the top, FII pulled out 16,500 crores. Why? This is because of the Adani factor. The Hindenburg report came, created a scare around the Adani stocks and also on banking stocks, which were perceived to be having lent to Adani, which was a wrong thing. But because of that, the market volatility brought the 3-month returns also down to red just before the budget. The budget was a very good budget, as I discussed during my last E.M.I. On that day, mutual funds bought, if you can see the bottom right, 8,000 crores. By 1 o'clock in the afternoon. But FIIs, because of the Adani factor still prevalent in their mind, took that opportunity of the short-term bounce in prices to sell even more. So you saw that the 1-year returns also, as of the budget day, started turning negative, apart from the large cap component. Now, the month of February also saw a continuance of this effect. Because of the Adani factor, the whole month of February, we also saw that FIIs further sold 5,000 crores worth of stocks. Hence, the 6 months returns also turned negative. Now, in March, there was some recovery. If you can see, first 2 weeks of March, FIIs actually brought in 14,700 crores, which means they had absorbed the Adani factor, realized that it was not so big a problem, and started putting money back. Unfortunately, what happened then was the SVB bank, Silicon Valley banks collapsing, saw that again FIIs from March 14 to 23rd, the next 10 days, have pulled out another 7,000 crores and taken back the markets to green in a significant way. So this factor, as you can see, what kind of a bounce back which was there in the last half of the last year, suddenly turned negative, starting with the FIIs profit booking in second half of December, then the Adani factor over the first 2 months of the new year, and the second being the SVB factor, which caused some amount of panic. This is despite Indian economy is posting very good numbers and the budget being very pro-growth budget, right? So that's the situation, the volatility. So this time, while the oil prices have been stable, the volatility has been crossed by the Adani factor and the Silicon Valley Bank factor. Right? What is the Silicon Valley Bank for? I have some slides on that, but let me just focus on the fact that Silicon Valley Bank had a very concentrated depositor base, and they were lending essentially into the venture capital and the new age tech companies. As you know, funding dried up there. They didn't have opportunity to lend, so they went and put their money into long-term US government securities. And as you know, interest rates have been rising, and hence when one depositor pulled out money, they had to go and sell their investments at a loss. That created a panic, and people then started, and because a very concentrated deposit base, it created a panic and a run, and the Fed had to step in and bail them out. So this is a classic case, not of bad loans, but of wrong investment decision from an asset liability mismatch perspective. Right. So that's essentially what is there in these slides. If there are Q&A, I can come back to these slides to describe those to you. But if you now look at the fact of Indian banks, right? The Indian banking sector is well protected. Why? Because household depositors bring more than 60% of the deposits, number one. Number two, if you see, within that, they have a greater dependence on term deposit and saving, and not so much on current account, which is hot money. Third is that GSECs are only 18% of the assets for private sector banks and 22%. So not much exposure to the investment side, where the rising interest rates will cause them to take mark-to-market losses. So overall, MTM loss on the portfolio of Indian banks is just 6% of net worth, whereas the entire net worth was being wiped out for Silicon Valley Bank. So there is no cause for the Indian banking system to worry about a contagion effect on account of the Silicon Valley Bank or the subsequent Credit Suisse collapse, right? So then when you look at the short-term outlook for the market, right, essentially you'll have to look at earnings, valuations, and the flows. And on earnings, I'll just give you a summary of the previous quarter's earnings. 90% reported results. 9% was the overall market growth, but non-financials only was -9%. So clearly financials were the outperformer. So as you can see, financial, despite being an outperformer in earnings, have taken a huge beating because of Adani as well as because of the SVB factor, right? At the very bottom, there are sectors which have done well, not well. At the very bottom, this quarter's earnings has not altered the outlook for what the total Nifty earnings for this year and next year will be. Hence, earnings are not a concern at this point in time. Number one, for short-term inflows. On valuations, right? Let us remember that I showed you FII is owning 37% of Indians' free float market cap, right? Non-promoter holding. But this ownership of India to the extent of 35 to 45% has been there from 2006. So FIs have been consistently owning almost 40% of market for 16 years. Keep that in mind. Now, these flows, obviously from insurance and pension funds, are also longer term money. Then when you then look at it, even passive mutual funds like ETFs, 15% of the share comes from there. And that's gone from just 7% 10 years ago to more than double this year. So clearly, India has received a significant allocation from foreign investors over this period of time. Hence, Indian market has always traded at a premium to both the world market as well as the emerging market, as this graph tells you, except during the global financial crisis, during COVID for a few months. India has always traded at a premium, right? So this valuation concern I'm trying to address to say that for 16 years, India has been a premium. Why is that? Because in an FIS portfolio, India is a stock. So when India is a stock, every portfolio in India also will have some stocks at 60, 65 PE, some stocks at 10, 15 PE. Because when you have predictability of earnings growth, then you're willing to pay a higher price. When either it's cyclical or you're unsure of the earnings growth, that's when the PE gets discounted. India has a strong, solid growth story. Hence, that predictability factor is allowing us to be trading at a premium. So please bear that in mind when you look at valuations. And the second reason that Indian market hasn't fallen despite FII volatility is because domestic mutual funds and insurance companies. So domestic mutual funds have bought 1,85,000 crores worth of stock. Insurance companies have bought a further 90,000 crores worth of stock. So their buying also meant that when the FIs sold, the market didn't drop as much. But when the FIs were buying and domestic were buying, it means that the market actually increased in its valuation. Now, if you then look at it from a relative valuation today, India continues to trade at a premium, though that premium is corrected. As you can see, our MSCI India index is at a 21.6 as per the index in abroad. World is at 16.1 and the emerging market is at 11.3. So India continues to be, the gap has narrowed, as you can see from the graph, we are elevated. But most recently, because of the Adani factor and the SVB factor, we have, what has happened is our spread between that, the extent of premium has come down. So compared to a few weeks ago, our market is now at a lesser premium. So if at all valuation was a concern in some people's mind a few months ago, today there has been a strong correction in that valuation, and we are trading today at the red line, which is the 9% premium to emerging market, which is our historic average, right? So from that point of view, if you see now, because of this correction, India's weight in the global market cap has dropped sharply to 3%. 3 standard deviation. So that means that though it is well above its mean, there is enough room for the market to go back up without being a concern around short-term valuations. And then when you look at our valuations compared to our own historic valuations, the Nifty index, if you can see, at sometimes has traded at 25 PE 1 year forward, sometimes 23. So last year, June, today is trading. The red line in the middle tells you the long-term average Nifty PE is 19.5. And today we are trading at around 16. If you can see, I have circled it. So India is trading well below its own historic average PE for the large cap. So clearly, we cannot say that today in India market, India is overvalued. Our premium to world and emerging markets is corrected. And our own market's long-term forward, 1 year forward PE is trading below its historical average. So Indian market is reasonably priced is a conclusion we must draw. And then when you compare to large, mid, and small caps and look at their valuation in this chart, what it tells you in this table, you can look at the top and then you look at the bottom, is that this is a comparison of the mid cap index versus large cap and the small cap versus large cap. In December 2017, when the market was at its peak, mid cap index was trading at a 35% premium and small cap at a 12% premium. Today, mid cap is at 11% discount and small cap at a 7% discount. So clearly, large cap itself is trading below its long-term average, but mid and small cap are trading at even deeper discounts to the large cap. So overall, broadly, one can say that the Indian market is today reasonably valued. What about the flows? As we spoke about the flows, and I've taken a summary here, since the post-COVID phase, right? There's 1,86,215 crores, which had come to India post-COVID, which is not in our market today. So the potential for our market is for that FII money, which was invested in India to come back. This is a huge sum of money because domestic mutual funds over this period have put in almost 1,97,000 crores. So this 1,86,000 crores to come back, when it comes back is when the market will take the next leap up. What will drive that? As we discussed before, it is for India, the direction of oil prices. And so from an oil price perspective, this chart tells you that the world oil demand is about 100 million barrels per day, of which 70 million barrels, that is 70%, is supplied by non-OPEC countries who sell all the oil they can dig out of the ground because it's important for their economy. The balance gap of 30 million barrels, however, OPEC, which is a cartel, supplies only 27. And they keep an artificial gap of 2 so that the price doesn't drop, right? Now, that's the reason why, if you see the oil price, when it dropped from 125 to 80, stuck at around the 80 levels now. Why? Because of this. Then when will oil prices correct? Why this oil price today hasn't dropped beyond after that drop is because it's a winter time in the US and America. So energy demand is high. So OPEC is able to ensure that the price remains high. Second, so the point is that Mr. Biden put a price cap on the Russian oil. As a result, Russia refused to supply to those who accept the price cap. So those countries are forced to go to Saudi Arabia and the OPEC and buy oil. This is the reason that oil price has stabilized at the 80 levels. But when do we think it will correct? When we see the summer coming, automatically oil demand will drop. Number two is the fact that the war continuing and the world slowdown continuing, as it is, oil demand will drop. So coming 2 to 3 months, you can ideally do expect that the oil prices will tend to trend down. And then when you see here, I've circled in the first chart, in 2020, when oil prices went down significantly, there was just a 10% drop in world demand from 100 million barrels to 91 million barrels. But as you can see, OPEC even then had to produce 25 million, resulting in an oil surplus and the prices crashing. To how much? You can see during COVID, it had dropped very sharply to almost $20 to $30, right? So I think the outlook for the FII money of 1,85,000 crores to come back has to wait for the next move of oil from the current $85 levels. And you can see already the small drop has started. But for this to go towards $60, $65, you will see FII money coming back into the Indian market. So that's one trigger for everybody to track, right? The second one is the fact is that from the point of view of this is global interest rates. Why? Because when interest rates rise, the world stock market indices rise, but the interest rate rise leads to a dollar strength, means emerging market corrects. So whenever dollar is strengthening, emerging market tends to correct because cost of money of people who want to borrow in dollars and invest in emerging markets like India goes up, and hence they pull back their money. So a rising interest rate is not good news for emerging market allocations. But a falling interest rate is very good. So as you know, the latest Silicon Valley Bank episode meant that the Fed in their commentary, though they hiked by 25, talked about taking a tactical call on future hikes. And they said they will actually start cutting rates by next year. But the market, in fact, expects the rate cuts to start even this year. So in a rate cut cycle, that happens. As you can see here, this is what I was telling about the dollar weighing on the emergency. The 1 month return, all the emergencies were negative because the dollar were rising. But the story is changing, is seen in the fact that gold price has started rising because gold is an alter ego of the dollar. Why? Because today gold price is determined by sovereign wealth funds changing over their thing from gold to dollar, dollar to gold. So in that point of view, right, if you see here, gold price has shown a sharp bounce back when the US fixed income has shown sharp correction. The Fed cuts or rises rates in the short end, the long end is by market. So clearly the market is expecting the dollar to weaken. So as a result of which, I think that from an outlook perspective, when the actual rate cuts start happening, you will see money flowing back to emerging markets and back to markets like India. So from a medium-term outlook, foreign investors, as I already explained to you, we are actually going from 12 to 16% and further up because our share of world GDP is in the rise. And then when you look at it, right, the projected rise in per capita income from this will also lead to bank deposits growing up. So domestic flows also should get a support from the banking system and the mutual fund taking a share. Because then when you look at it, actually speaking, the share of financial assets in India has gone up related to fiscal assets whenever inflation comes down. That's the trade story of the last few years. And over the next few years, as inflation will be stable, we think financial assets will shoot up. And because of that, if you see in an easing inflation world, we should have higher financial savings, of which household financial assets should itself start moving up. We are among the lowest in the world, and mutual fund assets as a percentage of GDP should also be going up. So I think if that is the case, you will find that already individual investors are investing in India in a big way, have been taking this up. So from that point of view, if you see the number of investors in the mutual fund has shown a sharp increase, and you're also seeing people through demat accounts taking exposure in the stock market. But as you can see, 90% of them lose money in the stock market. So the mutual industry is ready to capitalize on all these new entrants and greater allocation from them. So I expect this strong SIP book of 13,000 to grow to 15 and 20,000 crores and provide strong continued buying support to the stock market. That buying support will then lead to a growth. So if you see India's, we do expect a 10 to 12% nominal GDP growth. And over the last 15 years, as you can see, stock market, whether it's India, China, South Korea, always give a better return than the nominal GDP. The table at the top left gives you that. So with a 12% kind of nominal GDP growth expected over the next 15 years, we do think the stock market is in a position to give kind of double-digit returns. So with that, I'll conclude my thing for today. Thank you and wish you all the very, very best. Thanks.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.